welcome back, traders and investors. We have on the line with us Chuck Self, Chief Investment Advisor over at iSectors. And Chuck, welcome. How you doing this morning?
I'm doing well, Garrett. Thank you very much for having me on.
Yeah, definitely greatly appreciate you coming on. So tell me a little bit about iSectors. You have about 30 years in the investment industry. What's going on over at iSectors? What are you guys seeing in the markets right now, and what's your expectations here?
Well, to tell you a little bit about iSectors, we are an intellectual property firm in that we provide investment models to financial advisors. Most of them are quantitative, objective work, and so everything we do is based on our quantitative work. And currently, our quantitative models behind our flagship post-modern portfolio theory or post-MPT strategies are still very positive. We've been positive on the market for the last certainly 6 to 9 months, and we are fully invested at this point in the equity market.
Chuck, everyone is talking about these oil prices. Can we get your views on that?
Sure. We believe that this is a sea change in the oil market, and it's unfortunately I'm old enough to remember the early '80s when OPEC did something similar, in which they allowed the prices to decline pretty significantly, down 80% or so, because especially Saudi Arabia wanted to make sure that they maintained market shares. And certainly the increase in the U.S. Production has impacted their market share. And since, both demand and supply are inelastic and that you don't tend to have much change in actual behavior, unless you have large changes in oil prices, it makes sense that if this is the way they want to have their they want to keep their market share, that there's going to be major changes in prices, and that's what has happened.
So let's talk about what sectors you guys have been focusing right now. I know in your notes I saw that you guys are overweight on financials, healthcare, and technology. Can you go into a little more detail about that?
Sure. On the financial side, we think that just the increase in the economy into next year is increasing both consumer and business loan demand and also demand for services in the financial sector. So there's going to be that increase that will help the earnings of those companies. But also, we are starting to see regulations ease, and of course, just with the bill that was passed in this past week in Congress and signed by the president, there's some abilities certainly for the large banks to be able to have more room in activities that they do. So we believe that hasn't been completely reflected in the market, and so we are very positive on financials. On the healthcare side, no one expected to see as quickly as it happened the demand for services and for drugs and medical supplies that has taken place because of the Affordable Care Act. And again, we believe that that's the demand that's going to continue to increase, and certainly for the service providers like hospitals, they're now getting paid for services that they used to give away for free for a lot of services. And then the pharmaceutical companies are seeing greater demands for their products. The other great thing about the healthcare business is that that large companies have strong balance sheets, and they're going out and doing M&A. We saw that in the Merck Cubist deal last week. And then on the technology side, we have again the cyclical increase in the demand for both consumers and businesses because of the better economy. But technology had been underinvested by the business sector coming out of the 2008 recession, and starting this year, we're starting to see that spending go back to trend. I'm sure Microsoft helped by not supporting XP anymore because XP was by far the largest platform. And often when those kind of changes occur, they not only buy businesses not only buy new software, but they buy new equipment and they look at their whole systems, and they're financially stable now to do that. So we continue to see large increase in demands for technology type of items, and then we've started to see the IPO market heat up, and that also helps the technology. The great thing about this bull market, unlike the one in the 90s, is that even though there's been some sectors that have done very well, we look at the two best sectors this year, it's been healthcare and utilities. Certainly not sectors that are sizzling in investors' minds, and so this has not been a bubble type equity market rise where one sector just takes over. And we've also seen as the year gone on a rotation amongst sectors that have done well, and we forget about it now, but there was a time in this year in which the energy sector actually did the best. And so having this continued rotation in sectors is good for the market.
Absolutely. Now, what sectors are you guys underweight right now?
Well, energy, as we talked about, we think that this is again just the beginning of it may be a multi-year process of having relatively low oil prices. Although the Saudis were, they may be targeting North America, the thing that we have going for us is that the fracking technology is just getting cheaper and cheaper every year. And then we're not even the largest country that has oil shale. Besides the U.S. and Canada, China, Argentina, and Algeria all have a larger amount of oil share than we have. China has started fracking, but Argentina and Algeria have not done anything at all of any note. So the ability to get oil supply out into the marketplace is huge. The other, actually, we think that even though this might have been targeted to North American oil companies, countries like Russia and Venezuela, even Angola, are going to be the first places where we're going to see reduction in oil supply. But the whole point is that it may be a long time before we see triple-digit oil prices again. And given the volatility that we're going to see in energy, we rather not be part of that. On the basic material side, it's a stronger dollar problem there, and we expect the U.S. to continue to be the U.S. dollar continue to perform well. We have the best economy of the developed economies. We have the highest longer-term interest rates, and the Fed has the most credibility of any central bank. And so the demand to own U.S. dollars will continue to be strong. And then utilities, I already mentioned that utilities has been one of the best performing sectors this year, but we believe that this is a high valuation sector in a low growth area, and that they're going to have to, just because of the upswing in economy, utilities as a whole are going to have to increase their capital expenditure budgets to increase capacity. And so there's certainly been the search for yield, and utilities have been a safe place to be because of that. But our work shows that utilities are significantly overvalued.
So iSectors obviously focuses on ETFs. I'd love to get your opinion on the structural advantages of ETFs over mutual funds.
Yeah, well, there's a number of structural advantages. Of course, the most obvious is that they're traded throughout the day, so you're able to go in and out of the markets anytime you wish during the market day. But there are other structural advantages. Because of the way ETFs are created and disposed, ETF investment managers don't have to have cash positions. When an ETF is created, the market maker has to deliver the securities that are in the ETF. So there's you don't have to worry about all of a sudden a lot of cash going into an ETF and the portfolio managers, just trying to get it to invest it. Same thing on the redemption side. When a basket that creates an ETF is redeemed, the holder gets back securities from the ETF, not cash. So again, you don't have to have cash as a portfolio manager. So you really get the most pure return possible when you own ETFs, and that helps investors meet their goal. The other thing, although there is a move afoot to change this, is that every day the ETF investment manager has to publish what's in her or his portfolio, and because of that, there's complete transparency of what is being owned, even in the active managed ETFs. There's Eaton Vance is putting a little chink in that armor, in that they've got to prove the first ETF type of security that wouldn't allow complete transparency. But the SEC seems to be slow in approving just having all out, allowing ETF managers not to have complete transparency. And so that's also good for investors, in that you know, just by going on the websites, you can figure out at any point in time what is being owned in an ETF.
What are some of the advantages of portfolio construction using sectors versus like a cap style fund, a large growth fund, things like that?
Well, the major advantage is that if you look at what has happened over the past 10 years, the correlation between different sectors in the style cap funds, you know, large growth, small value, and so on, has continued to rise. And of course, during the 2007 to 2009 market decline, that correlation went very close to 1, being fully correlated. We've calculated the correlations over the past 5 years, and the correlation is between any two pair is at least 80%, and in some cases they're up into the 90%. When you do that same calculations using sectors, especially when you take out the consumer sectors. We don't utilize the consumer sectors in creating our portfolios. Those correlations go down pretty significantly. The absolute highest correlation is between energy and materials at 77%, and you actually have negative correlations between utilities and technology, for instance. And so we are able, the whole purpose of diversification is not just to own as many assets as possible, but to own as many relatively uncorrelated assets as possible. And so we're constructing our portfolios with relatively uncorrelated assets. And in the case of our flagship model, or the post-MPT growth model, we have pretty much the exact same standard deviation as the S&P 500, but our correlation in the 10 years it's been in existence is about 0.32, or 32%. So that way, investors get truly diversified returns, reduces downside risk in the down markets, and makes them more attractive portfolio construction than your typical style cap type portfolios.
We've only got about 5 minutes left with you, Chuck, so I'd love to switch gears. What'd you think about the Fed announcement yesterday?
Well, it was what we had expected. I think the market had pretty much expected. Although, given the reaction in the marketplace, it's clear that there was concern that maybe the Fed would either under or overplay their hands, and you know, it looks like the porridge was just right for the market. Our expectations was, and it continues to be, that the Fed is going to start increasing interest rates next year, probably sometime in the summer, late summer, early fall, and that once it gets started, they're going to be, again, very slow to increase rates. In fact, the Fed Funds future contract, if you look at it due 2016, indicates that the Fed is probably going to be increasing interest rates every other meeting by 25 basis points. And we believe that that's what's going to happen. It's interesting that that's what's implied in the market, but both the Fed itself and the surveys of market participants think that the Fed is going to go faster. So our historical experience has been that you should trust the Fed fund futures market more than you should the industry prognosticators. So we think that by year end next year, Fed fund rates may be only 50 basis points, and then at 1.5% by the end of 2016. So it's if the Fed increases rates that slowly, that should not have significantly negative impact on the equity market at a time when earnings should be growing next year. And again, the U.S. dollar continues to be a good place to be. So that's all that is going into why our models are positive for next year.
Okay, Chris. Well, we appreciate you coming on the show this morning. We wish you well going through the week, and thank you again for coming on and explaining to us what's going on over at iSectors and what you guys are looking at and seeing.
We've had
Okay, thank you very much, Garrett.